Hello and welcome to episode 8 of the Wild Bat podcast. We are still going with the income tax and CCPC course. This is module 6, passive income, refundable part 1 tax, and capital dividends. Alrighty, as you can see, I've got a basketball hoop, and this is halfway through the income tax and CCPC course. So, passive income, a corporation can receive passive income, including rent, interest, royalty payment, and capital gains. This passive income is not active business income, so there is no small business deduction of 19% and no general rate reduction of 13%. It is taxed at the highest corporate rate, and on top of that, there is another refundable tax that is levied on. The purpose of this is to ensure that there is no tax deferral and that corporations are punished even for holding investments. If you are in the highest tax bracket personally, you may find an advantage incorporating your investments. However, if you're not, you would prefer to unincorporate, as we will see. Passive income, such as interest and capital gains and royalties and rents and what have you, are not taxed the same as dividends under Part 4, but are included as taxable income and taxed in Part 1. It, again, is a tax at the highest corporate rate, and there's a refundable Part 1 tax that is levied on at 10 and 2/3%, or 10.666, sign of the devil, percent. But this refundable tax, when computed, can be returned to the shareholders and is recovered. We're going to shoot over to the IV-Post scanner right now, where we are going to look at a basic example of how investment income will, how a corporation is going to treat investment income. So we're going to have an excess of ABI. So regardless of what your active business income is, we're going to ignore that just for this example. Let's say we have interest income from bonds of $15,000. As part of having this portfolio, there is going to be a management fee. This provides us a net investment income of $14,500. Right, let's start playing with some taxes. So, the first tax is our federal tax of 38%, which is $5,510. Yep. And then we're going to have our refundable tax. Part 1 levied at 10.666%. $546.57. Alrighty, that gives us a total federal tax component of $7,056.57. Now there is a provincial tax abatement of 10% that we get to reduce, which is a pretty simple for $1,450. Now this is based on if the income is earned in a Canadian province. back to front, writing up stuff. Alrighty, and we're going to be in Alberta, which only has an 8% federal tax. Best place to be. Alrighty, so our total tax to pay for our investment income is going to be $6,766.57, or a net average an average tax rate of 46.66%. Okay, now this is it's good to be living in Alberta with 8%, and but this is excluding any of the ABI, and we have not refunded the tax yet via issuing a dividend. Aggregate investment income includes both Canadian and foreign sourced. If you look up the definition in the Income Tax Act, Section 129, Part 4, Part A, you will see that it includes eligible taxable capital gains. Capital gains are 50% taxed and 50% tax-free. And any income that is sourced from property during the year, such as interest and rents, royalties, but not dividends. Dividends are taxed separately. Note that any losses from that income source are applied against the other income from the same source to result in a net. This also includes management fees and such. One thing that you need to consider is that there are no tax deferral benefits, generally speaking, when it comes to holding investment property in a corporation. This is designed so that you can't incorporate your investment. If you are a high earner, you may find this beneficial. The refundable tax is taxed at that 10, isn't taxed on top of the federal tax base amount of 38%, and we add on that 10 2/3%, or 10.666, to the lesser of the aggregate investment income, or the or the taxable income that is in excess of the small business deduction income. The way I like to look at it is investment income is taxed in the following way: 38%, then you add on that refundable tax that's levied of 10.666, you reduce it by 10%, providing the provincial abatement. So federally, the taxable income, so the investment income, is taxed at 38.666%. And if you're in Alberta, you add on another 8%, so that results in a 46.666%, which is what we had in our prior example as well. The refundable tax is put into the same tax account as the dividend tax. This is called the refundable dividend tax on hand, and is only refundable when a dividend is then on paid to its shareholders. Note that the shareholders don't receive interest, rent, or royalty payments from the corporation. They only receive dividends. So it follows the same stream as the dividends, and even though it gets put into the same tax account. The refund is the lesser of 38.333% of the dividend paid, or the refundable dividend tax credit on hand at the end of the year. The dividend refund pool, or the RDTOH pool, is a total of 4 components. The first things first, we have to figure out the lesser of the 3 amounts, being the tax payable of aggregate investment income, excess of taxable income on SPD, or corporate tax payable. Once we figure out the lesser of these three amounts, we add this to the total taxes that refundable taxes payable under Part 4 tax from dividends received. We add this to the refundable dividend taxes paid from the preceding or prior year, and then we minus off the dividend refund that was applied in the preceding year. I'm going to shoot over to iVipo Scanner to outline this concept fully. Okay, we're going to look at our refundable dividend tax on hand example. It's going to be a little bit complicated, so bear with me. In this example here, we are going to have active business income of $100,000. We're going to have portfolio dividends of $10,000. We're going to have investment interest income of $8,000, and we're going to have taxable capital gains of $4,000. Our total income will be $22,000. So we don't need to calculate all this, but our small business deduction is going to be only applied to the ABI of 19%, so $19,000. We're just going to need that example for later. Right, let's get into this calculation. Alrighty, the first part is we've got to calculate Part A. Part A, we're trying to find the lesser of aggregate income, excess of taxable income, or tax payable. Which one of these is the smallest? Let's look at our aggregate income first. Our aggregate income is going to include both the interest and the taxable capital gains. So we're going to have our interest here and capital gains here. 8,000 plus 4,000, that's 12,000. We are going to times this $12,000 by the 30.66% to give our refundable tax of $3,679.20. Next, we have to calculate the excess of our taxable income to the small business deduction. So this time we include active business income of $100,000. We add investment, interest investment, and our capital gains, 8,000 and 4,000. Now we have to do something really wacky. We actually have to reduce this amount by the so we add this all up, and then we've got to reduce the best way to do it is to reduce the amount that's applicable to the small business deduction, which is going to be $100,000 here. So it's going to be we're going to have $12,000 again. It's going to be exactly the exact same result as Part 1, where we are going to times that by our 30.66%. So there's no point in really recalculating this. We know that it's going to be the same. The last part is going to be our tax payable. Our tax payable is going to include this amount here. However, the calculation here we can salvage. So it is going to include our active business income we're going to tax our active business income, interest, and capital gains. So we'll just call that ABI taxable total of $112,000. $100,000, and that is going to be taxed at 28%, which is going to give us $31,360. Now, before I go on with this calculation, it gets a little bit convoluted because, again, we've got to apply the small business deduction to this $100,000. So the best way I would actually recommend is actually dissecting it out again. This is not going to be taxed. This is going to be taxed at a different rate. So it's better to actually tax the ABI in one way and then tax the aggregate investment income in another method. So what we're going to do here is what we're going to do here is we're actually going to dissect it out. So I've got $100,000 here, which is going to be taxed at 28%. So we'll get rid of this calculation now. Tax it at 28% minus our small business deduction of 19%. So 9%. So that gives us our $9,000 on our ABI. Now the remainder, the $12,000, so the $12,000, the aggregate investment income, is going to be taxed at 10.66%, not 30.66%, because we are going to try and figure out what the difference between we are trying to tax the ABI and the aggregate, but the aggregate is taxed at the levied amount. So it's really simple here. $12,000 times 0.1066, or times 10.6%, 66%, which gives us our total of $1,200.79 plus 9,000 gives us our tax payable amount. Bit convoluted way of getting there, but it's a complex calculation. $10,279.20. So as you can see right here, either one of these is going to be our lesser. So we're going to choose that. That's part A. Part B is going to be what our part 4 taxes are. Really simple here. $10,000 of our dividends here, which are taxed at 38.33%. I don't need a calculator for this. $3,833.33. Now we add these two up, which I'm going to need a calculator for there. That gives us our total refundable dividend tax on hand for this year of $7,512.53. We're going to assume that there is no refundable dividend tax on hand for the prior year, and hence none paid out, or it's exactly the same. Whatever was incurred in the prior year was paid out. So, as I said, what we're going to do here is we want to make sure that these refundable taxes are paid and then recovered immediately. So we have to figure out a dividend that we're going to declare. The dividend calculation is pretty simple. It is going to be this amount here divided by 38.33%, which will give us a dividend, if we declare, of $19,600. If we declare this dividend, we will have a null tax impact on the tax return. capital dividends are taxed only at 50% of what is incurred. This means that if you have a shareholding or you have property and it results in a capital gain, you only recognize 50% of that gain, and that is taxed. The other half of this is the tax-free amount, which is held in the capital dividend account, or CDA. This is to be distributed to the shareholders tax-free. The CDA includes a non-taxable portion of any capital gains, which are in excess of the capital losses. It also includes any capital dividends received from any other corporations. It also includes the non-taxable portion of any gain of any other eligible capital property. If you have a life insurance policy that your corporation is the beneficiary of, the proceeds of the policy, net the adjusted cost base, or ACB, are included here, and the balance of the corporation's, the life insurance corporation's CDA, or capital dividend accounts, included here. One thing with capital dividends is that if you have to, in order to get the capital dividends, you have to elect an amount via T-slip 2054. If you exceed the amount in your CDA, your capital dividend account, then you get taxed. You get a tax punishment, and that's not very fair. 20% of any excess of the dividend that you've allocated. However, with proper tax planning, the procedure is you request the CDA balance from the CRA, and then once you get this, you also follow up with electing dividends in chunks. So if you have $158,000 worth of CDA that you want to elect and pay out via capital dividends, you would do chunks of 50,000, and then the next day do another chunk of 50,000, and the next day do another chunk of 50,000, which can be all included on the same T2054. You want to make sure you get this planning right. It's you don't want to give any more money than you need to the CRA. All right, thank you for joining me. I know it was a long one. Join me for the next module, Module 7, which we're going to talk about passive income, eligible dividend rules. Should be a bit easier going forward. We are at the halfway point of the income tax course, so please continue. Thank you and good night.